What's up guys, it's Chris here. Today it's very simple. Over the last 2 years I have been investing consistently into the markets through a number of different industries, but there is one method of investing I have been using that has brought me without a doubt the best results in these current markets. So today I'm going to be showing you my best performing investments over the last 2 years, as well as the exact strategy that I've been using to get these kind of returns and why I think it is something everyone should be using in their portfolios as well. Then at the end of the video, we will be buying 4 brand new investments using this exact strategy to get profits in the future. So if you want to see the methods I have been using to make good gains in these recession time markets, then let's get started. In the beginning of 2022, the whole world of investors started to see a shift in the markets. We went from a very weird time in 2020 to an unstoppable market rally. In about 2 years, the entire market roughly doubled from the lows of the pandemic, but then slowly but surely things started to change. At first we saw a small dip and then a bit more of a decrease, and before we knew it, things were running away from us, and the last 17 months has just been a downward slide and is still about 13% lower than it was in January of last year. But despite that, and with the market seemingly moving nothing but downward, we have 3 specific different investments using this method that are not 13% down, but rather around 13% in profit. So what are these investments and what is the method we used, and why should you maybe be using it too? Well, when last year started, I began an experiment, and the result of that experiment had some unexpected consequences. The experiment was a simple one. What would make more money over a year, investing in the stock market or playing the lottery? I wanted to see that if I invested the same amount as I used to buy lottery tickets, then by December which one would give me a better return. We started the experiment and we recorded the progress and the results on the channel. We made 3 different investments each month of 100 Rand each, and we bought 100 Rand in lottery tickets. The long story short is that the winner was investing in the markets. Although we did win some money on the lottery, the investment results were better. But then I started to notice something. Those investments I was making were doing really well. Quite well, in fact, that they were performing better than the markets were doing. So I kept going, and today they are my best performing investments in my portfolio over the long term, and I now know why. So here they are, the 3 investments we have been making into the major market indexes. We have been investing money into the core shares S&P 500, which are the 500 largest companies in the USA, the Satrix Top 40, the 40 largest companies in SA, and the Signia FTSE 100, the 100 largest companies in the UK. Now, all 3 of these you can also buy yourself in EasyEquities in the Rand section. Just simply go to Invest and ETFs and search for them. But if you remember the graphs we were just showing, that was the S&P 500, one of the investments we have, and as you saw, that index went down by 13%. So how did we invest in the same thing and make a profit? The answer came by default, but it also happens to be the most reliable way to make profits in the market and is used by some of the biggest investors in the world. The strategy that allowed us to make a profit is called dollar cost averaging. Now, you may have heard that term before. It refers to an approach to purchasing an investment in which the buyer spreads out their purchases so that the total price paid is less affected by market timing. Basically speaking, because I was investing the same amount at the same time every month, I was dollar cost averaging my investment. And by doing that, I was able to make a profit during an overall down market. Let's take a look at an example here. This is what the markets looked like during 2020. You can see that huge V shape during the pandemic. Now, at the time, no one knew when the bottom would be, but by investing each and every month, you are able to buy in all the way down, like here and here and here and here, and at the bottom here and here, and even on the way up, like here and here and here. So that by the time the markets have reached back to normal, you have been able to invest at all the lowest prices without any risk of timing the market, and at this point every single one of your investments will be in profits, with the ones at the bottom being at the highest amounts of profits. So even though the market hasn't gone anywhere and could even have gone down, you will have made a profit. So in January last year, we were investing all along the bottom here, getting great prices, and as the market slowly moved up, literally all our investments are in profit, and some by as much as a crazy 23% gain. And that was seen with all 3 of our index funds, with all 44 investments made in profit. The highest was over 30% and just 1 in red, which is a strange outlier. But this is more than just a happy coincidence to an experiment. There is so much research and science that backs this as an investment strategy. This is a study done over 40 years where they took 3 people investing. One had the worst luck and invested right before all the biggest crashes, one had the best luck and invested at the lowest right before every rally, and one invested the same amount every month no matter what. And at the end of the study, the person investing each month no matter what had the best returns. But there is more to it than just the strategy. You need to invest in the right places as well, and that is where the index funds come in. These three funds are ETFs made up of the largest companies in each country which span a number of industries. They are on the least risky investments you can make in the markets, knowing of course there is always a level of risk. In fact, here is another statistic. In the entire history of the S&P 500 index, there has never been a 20-year period that has not given a profit. So if you invested any time in history, over 20 years at least, you would make a profit. But more than that, let's zoom out on all these three graphs. Although there are ups and downs, due to a number of factors, these prices always surpass previous highs to reach new profit levels. And with all of the data, perhaps the biggest endorsement of the method comes from Warren Buffett, the Oracle of Omaha himself, who said to CNBC in 2017 that diversified index funds make the most sense practically all of the time, and he says to consistently buy an S&P 500 low-cost index fund and to keep buying it through thick and thin, and especially through thin, which, as we have said, is where the best profits are long-term. And the results speak for themselves. Instead of theory, we put this into practice, and these are real-world investments with real money and real profits, which is why in last week's video we had this to say. Seeing this now and the returns that the strategy has been giving, maybe I actually need to start investing more in these, so I'll be looking into that. Now, we in general have a portfolio that is heavier on passive income, and because of that, growth is typically lower. Think of it like this: if you own a real estate company and you pay dividends every 3 months, you are losing that money, where if you didn't pay it, you would be able to pay down bonds and buy more properties. Now, as an investor, we can reinvest those dividends and grow our portfolio and holdings that way, which is very beneficial. But as a listed company, typically your share price doesn't grow as much as a company without dividends. Now, although index funds do pay dividends, which we'll get to, they tend to have better capital growth than high dividend companies. So, in order to have a balanced portfolio, we need to increase our capital gain holdings, and index funds are partly how we will do that. But we're going to do it slightly differently than we have so far. So let's take a look at the options we have. First of all, there are all kinds of broad index funds. We're going to go through 4, but pretty much every exchange will have an index of the top shares, from Australia to China to India and beyond. So if you want to start trying this investment method, these are some of the options that we will be buying and investing in right now. The first share we're going to be investing in today to add to our portfolio is the Vanguard S&P 500. Now, you might be asking that because we already have our core shares S&P 500, why are we buying into a different index now? Well, there are 2 reasons. The first is currency diversification. All of our current indexes are in rands, and it's always good to diversify your risk, but also the rand has underperformed all major currencies in the past, as you can see in our exchange rates. So you are likely to get better long-term returns by investing in dollars or pounds or euros. And secondly, I want to keep the experiment going to see what returns you can make by investing exactly the same amount every month over the long term. So if you want to see that, you're welcome to subscribe to the channel to see the results each month. Now, the Vanguard S&P 500 is often seen as the worldwide standard for S&P 500 investing and as the best and one of the largest ETF index funds in the world. Many are very similar, but Vanguard charges only 0.03% fee annually, meaning every 10,000 Rand invested would cost 3 Rand a year. So just 1% a year would cover your fees over 33 times. Also, the ETF pays out dividends every 3 months and is usually between 1.3 to 1.9% dividends a year. So we then went into EasyEquities and used the foreign exchange to transfer our rands into dollars, and we went into Invest Now and selected ETFs and searched for VOO, which is the symbol for the ETF. We then went on to buy $36 in this index fund. Now, as we said, we will be buying in smaller amounts consistently over the years into this fund to dollar cost average and grow our investment. The next fund we went to invest in is our very own Satrix 40, which is the same as the one we already have, but the difference is we will be buying it in a tax-free savings account to keep it separate, but also of course to save in tax. This fund is the most well-known of its kind in South Africa and run by Satrix, who charges only a 0.1% annual fee. This fund is paying around 3.5% dividends a year every 3 months, and because it's a South African fund, we'll be keeping this in rands. So let's head on over to the Invest Now, then click on ETFs and you can see it right here. So let's go in and we'll be purchasing 406 Rand of this index, again to keep adding to it over time to average out the buying cost and grow our holdings and capital. We do have a new index we're investing in today, but before we get to that, we're going to head on over to our top current performing index fund, which is the FTSE 100 in the UK. Like we said earlier, we want currency diversification, so we're going to the Forex and transferring our rands over to pounds sterling. Now, for this index, we're going to be using the HSBC FTSE 100 ETF. One, because we own shares in HSBC. Two, is that there are still limited options for this in EasyEquities. And three, is that it is a quality fund manager of the index with only a 0.07% management fee for a year. The current FTSE 100 dividend payment is around 3.5% as well, and HSBC pays this twice a year. So let's head over to Invest Now, then ETFs, select a fund, and we're going to be investing £21 into this ETF. Then lastly, there is a new ETF that we'll be buying today to add to our index fund portfolio, and that is the Euro Stoxx 50. As the name suggests, it is a collection of the 50 largest stocks in the Eurozone area. You will know some of these companies like Louis Vuitton, Moet Hennessy, which is the company of the richest man in the world right now, to Total Energies, SAP, Siemens, L'Oreal, Mercedes, and more. The fund is run by BlackRock, the largest fund manager in the world with $9 million under management, and their fee is also 0.1%. So why this ETF? Well, diversification is one reason, but also it actually outperformed all the other three with a return of 27% in just the last 6 months. Great returns, and has a 2.7% dividend yield. We could only do this in pounds because Europe in EasyEquities doesn't have many options, but also because the pound is relatively stable to the euro over time. So let's head to investments, click ETFs again, and we're going to make an investment into this ETF for £21. And guys, that is it for today's episode, where we take you through the real-world examples and benefits of dollar cost average investing into index funds and the profits this strategy can bring you. If you want to see our share purchases in real time like these ones here, you can check out our Patreon, and there are also spreadsheets you can download to track your investment income and values with graphs that automatically update with the data you put in. And if you haven't already, please feel free to like the video and subscribe to the channel to follow our portfolio and market news. But until then, I'll see you guys next time, as always, on Casual Cash. Cheers.